Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another live stream of 0x Research, the first one of the new year, and today we're joined by Alex from Dromos Labs, the company labs team behind Aero, now changed.
Yeah.
Originally Aerodrome, Velodrome. How you doing, Alex?
Doing well. It's my my first pod of the new year here too, so I feel like I'm shaking off the cobwebs a bit here. So thanks for having me on.
Very good. Thank you for coming on. I guess just to start us off, why did you guys decide to change it to Aero? Is a good way to go.
Yeah, I mean, if you think about the journey we've been on, right? Everything sort of started with Velodrome on OP Mainnet, and Velodrome quickly became sort of the leading exchange on OP Mainnet. And then it's, of course, expanded across now 10 different super chains, and it leads across almost all of them. It also meant we launched Aerodrome, which quickly became the leading exchange of Base, but that was a huge deal because Base is the L2 of Ethereum these days, so it was no small thing. And so I think as we began to think about the future, MetaDAO 3 is kind of a major upgrade to what we think is the leading DEX operating system on the market. And we thought it was time for these two protocols to come together as one to expand to mainnet Ethereum, right? And kind of be that one protocol, one name, one unified ecosystem to connect liquidity across all of Ethereum. And then, it's a classic, social network vibe of like, drop the drone. It's simpler. Just go with Aero. And actually, I do want to give some credit because quite some time ago, when I first shared with Jesse Pollock of the Base team our plan here, and we were talking about things, his question was like, well, so what are you going to call the thing? And we were kicking around a few different ideas. And when I mentioned Aero, he was like, no, that's it. You got to go with that. Now, it took us, another few months of arguing and debating, but that stuck in my head. So Aero, it's simpler.
Very good. I think I agree with Jesse and with you as well. I like the Aero name. Although I did really like the Velodrome branding as well. Like the bicycle was very, very cool. Is there anything that, I guess, like thinking about it, VE Velo stakers got Aero tokens. So there isn't anything functionally changing in terms of like revenues and everything, right? How's it going?
Correct. Yeah, the initial distribution is basically benchmarked on previous year revenue of the two protocols. So if you assumed, right, that the only thing that we announced last November was the two protocols coming together, and we announced a lot more expansion into new markets, major upgrades to the technology, the economics. But if it was just the merge and you were to benchmark your distribution of the revenue of the two protocols based on that past year, everybody's claim of the pie would be the exact same. So Aero, VE Aero, and Aero tokens are getting dropped proportionate to Aero's revenue. Same for Velo. But the great thing is you aren't actually getting a share of the same pie. You're getting a share of what we think will be a much larger pie, because right now these two protocols only service about 1/5 of total EVM volumes. So in theory, everybody's share of total rewards should grow.
That makes sense. You mentioned MetaDAO 03 a few times. At a high level, because I want to dive deeply into each section, what are the changes? So it's expansion into new chains as well as a few other things. What are they?
Yeah, so I mean, we think MetaDAO 03 is kind of the end game of the DEX design, spot exchange design that will finally unify liquidity across all of Ethereum. So there's a few key features probably worth hitting on here. One is the Air and Rev engines. And so these are basically big changes to the economics of the protocol, which we think are already the best economics in the industry. I mean, Aero led all DEXs last year in revenue by a substantial margin. And even if you look at, the sort of back testing of the fee switch on Uniswap, it would lead it significantly, even if it had been enabled over the same period. So the Aero and Rev engines basically make the economics much more adaptive. It means we internalize new revenue streams like aggregator fees, like MEV, like all these other things. We direct that to the token as well. So that is an increase in the amount of revenue coming into the system. And then the Aero engine means emissions can now be dynamically allocated, which means we can drop the amount of value out. So Aero and Rev engine simply just means more value in to the system, with less value coming out. And based on our back testing and estimates, it's like a 2.8x net increase in value, flowing back into the system. So we think these are really powerful new economic engines. The other big thing is Slipstream V3. So Slipstream V2 already leads, on a 3-to-1 margin versus Uni V2, V3, V4 combined, anywhere they compete. And Slipstream V3 will bring even more sort of upgrades, institutional level verification and KYC features, upgraded dynamic fees, and a whole bunch of other upgrades that will make it even more competitive than it is today. One I'm personally very excited about is MetaSwaps. So if you think about the experience of like swapping for assets on chain right now, there's still a lot of this confusion. You might have USDC sitting on mainnet Ethereum, and then you see, Jesse's tweeting about some token. You're having to go through all these bridges and get it over, and then you forgot to bridge the gas, so you have to bridge that. And then by the time you get there, which DEX do you use? Use an aggregator, et cetera. So MetaSwaps is basically the first totally bundled cross-chain swapper, aggregator, and bridge all in a single product. So you won't need to, it won't matter where you have your assets. If you see a token somewhere that you want, MetaSwaps make it possible for you to just click swap, trade executes on the chain. You don't need to worry about gas, any of this stuff. There's a bunch of other features we can get into. I mean, open pools just make it way easier for like token launchers and things to integrate directly within our system. Autopilot just makes the entire like earning yield process much, much simpler, whether you're a token operator, whether you're an LP, or you're participating in any number of these different ways. But the net result of this is that our hope is MetaDAO 3, Aero's expansion, this will be the liquidity infrastructure of Ethereum. And that means it's one place to go for the best place to trade, the best place to earn, and the best place to launch new tokens.
Perfect. It's a lot there. I guess, Danny, unless you have a first question I wanted to ask about.
Yeah, maybe just one quick follow-up there. Curious on, some talk about the expansion here, and you mentioned MetaSwaps, which sounds interesting. Like, are those intertwined in the sense that, you're looking to expand the product to maybe a few chains here and there, and then, this product will apply to those environments? Or is it kind of more broadly encompassing of, the variety of sort of like EVM ecosystems that exist?
Yeah, MetaSwaps will be live day one anywhere Aero is deployed, right? So on day one, that'll mean obviously the OP superchain that Velodrome serves today. That'll mean Base, that Aerodrome serves, Ethereum mainnet, Circle's Arc, and Syndicate's chain as well. And that'll mean, accessing and trading tokens and liquidity and all that sort of stuff across all those chains will be fully abstracted for the first time ever. And this has always been the vision, right, of the Ethereum scaling roadmap, is that it shouldn't feel like this fractured thing. You should be able to tap into this without needing to worry about what chain you're on. But we can continue to scale this to any chain where we see activity, users, interests. And the great thing is because of our decentralized DApp, we can scale infinitely at zero marginal cost because we don't rely on any centralized APIs, servers. We're probably like the largest protocol without like an AWS or cloud account. And so it's as easy as just deploying the contracts. The front end reads everything off chain. And so, while we will cover now, I think like 2/3 or maybe even more with those chains of global sort of EVM volumes. Addressing the markets we're not currently serving will be very easy.
And then just one more quick follow up there. Like, I think the expansion to like Ethereum mainnet makes a ton of sense. You know, a large amount of the EVM activity happens there, of course. ARC and Syndicate are interesting. Like, I'm curious the decision making behind like some of these newer teams and ecosystems coming to market versus like, I don't know, like an Arbitrum or something along those lines.
Yeah.
What was the thinking?
Yeah, so I mean, yeah, like you said, Ethereum mainnet makes a ton of sense because that is still where the bulk of trading activity happens. So service that, win a significant share of that, and you are probably now the largest DEX in volume terms anywhere in EVM. In the choices beyond that, it's kind of about experimentation right now. I think in Syndicate we see a very, very interesting app chain model, and they have interest and ability in developing some like unique offerings. So being there day one is kind of like, okay, let's see what we can build together in that space, which I won't get too much into unless we get further along in the process before launch. But we see it as an experimental sort of place to go. I think ARC is super interesting because we've been very close partners with Circle for years, right? I think our EURC USDC pool is the top on-chain FX pool, and it's obviously, then their top FX pool anywhere on-chain. And with them, what we see is they built an L1 because they see an opportunity to onboard institutions that for them, even Ethereum chain is probably a step too far in the complexity. They know they want to get engaged on chain. They want to get engaged in tokenization, but they literally want to be able to like call a CEO somewhere, if something goes wrong. And so we see they have an opportunity perhaps to bring assets that would not ordinarily come in to other ecosystems. And they have the relationships at the institution level, I think, to do this. And by being the DEX infrastructure there, that means we are able to sort of host and service assets that we might not be able to otherwise. But then because of things like MetaSwaps, we give them distribution across broader EVM. And that would mean like, if there's really new interesting RWA and you want exposure to that, again, you don't have to worry about the fact that it's on ARC. You can just swap on the UI. So we want to be that sort of bridge. If they are going to bring net new issuers, net new users, institutions, our liquidity infrastructure can not only help them, but then bridge them back to the broader world of Ethereum.
Perfect. I'm going to go back to the MetaSwap for 1 second. So it's not, I guess, like a traditional aggregator in the way that like 1inch and Matcha is, and is more so like a unified front end for all Aero products. Are you guys planning on charging a fee for that usage, or will it just be treated as like the regular? Do you know what aggregators charge some form of whatever, like 5 bits or something? You guys aren't planning on doing that?
Yeah, it's something we're looking at because especially if, think about how cool this actually is, right? Because if you're on a chain right now with bad wrapped ETH USDC liquidity, and you could get better trading execution on the most basic swap or even the route of wrapped ETH USDC on another chain, you would have to go bridge that, right? Those funds in order to do that. And, most people are just not going to do that. They're going to eat a bad trade on the chain that they are on. So the big innovation here is the cross-chain aggregation of liquidity. And so if you just want ETH at the best price and you're on mainnet Ethereum and we can give it to you on base or vice versa, it'll route your trade. And so we do potentially see, if the, rates we are giving and the access we're giving on the cross-chain piece are significantly better than what other products can give in aggregating even multiple DEXs within a single chain, that perhaps there's some additional fee, but that fee, again, would only go back to the token, and the token goes back to incentivizing liquidity providers. So it'd just be a way of growing depth. across all of these chains versus like, there's going to be an entity taking that value out of the system. That's like core to us, is that all value needs to be internalized. All of it needs to be redirected to the token. All of the token needs to go to deepening liquidity, which fuels the overall flywheel.
Yeah, I think that makes sense. I guess like the reason that I was wondering is you might have to do some bridging, but it doesn't make any sense because you would just fill them on the chain that they get filled in, right? Like if I
there would be some bridging components in there, and we will have the ability to integrate with any bridging solution. So for instance, if you're going to Arc, right, you might be using Circle's solution. You might be using Layer 0. You might be using Hyperlane, right? And there'll be some degree of bridging fees there. But, overall, the goal is to keep the costs absolutely minimal. And if you know about how bad slippage can get, especially on low liquidity chains, I mean, it's going to be nothing in comparison to the value you will make up.
Yeah, I was recently looking at cross-chain swaps, and there are some providers that, like intense providers that take like 11 bips take, which is very, very high, obviously.
Yeah, I think it's the classic line of their margin is our opportunity, right? And so much of MetaDAO 3 is designed around, it does not make sense that an auto compounder should take 5 to 10%. Let's just build it directly into the product. And you could charge 1%, if anything, and then you redirect it back towards the token. Secondary marketplaces for voting positions, auto voters, all of these bridges, aggregators. There is just so much value that has been, I think, extracted out of systems at rates that are, I think quite offensive, or at least not what the market rate should be if they were being competed with effectively. And we want to internalize all of that margin. We want to charge the bare minimum. We want to redirect it all towards the token, and basically internalize all the value that DEXs so far have been very, very happy to leak.
Yeah, I think that makes sense. One last thing on the cross-chain side. VE tokenomics themselves are kind of, I would say, more complex than other token systems. How are you guys working around that? Like if I want to vote on a pool on a Ethereum, how is that going to work?
Yeah. I mean, I think that's where autopilot comes in. I mean, like that complexity has pros and cons, right? On the one hand, isn't it incredible that a entity like Coinbase Ventures can go out, buy a bunch of Aero, lock it up, and then use that to drive liquidity and business outcomes on base while earning back a ton of value for that activity. Like that utility is very good. It's complex. It takes some learning, takes some management, but that's a good thing. But on the other hand, if you're just a retail participant and you're just here to earn yield, that's where autopilot comes in, right? Where you can just say, hey, I've basically locked up some Aero. I'm going to toggle the autopilot button, and each week autopilot's going to vote automatically for me and return to me, that yield in the token of my choice, right? It could be auto compounding back into the position. It could be USDC. It could be Aero. But we want to ensure that the access to yield is as simple as possible. And that's why, by the way, on the LP side, we're building in things like ALM with no additional fees, why we're building in things like auto compounding with no additional fees or minimum fees that go back to the token, such that like even if you're just a mini app user on the base app, and it doesn't matter if you want to be operating, right, using locked positions, or you want to be LPing, it's just a one-click yield experience that is simple enough to manage on your phone.
Perfect. I thought this auto voting system or a form of it is already live, right? Like you guys have some form of an implementation, and I assume this one is just going to build on top of that.
Exactly. Yeah. So as of today, we have something called Relay, in which you can like deposit into the Maxi Relay vault, and it'll do that voting and compounding for you. In Autopilot, it's basically an upgrade where, right now it's only compounding back into the locked position versus converting your yield into the assets of your choice. There are also just some technical limitations on it right now around cross-chain voting. Doesn't work on the Velodrome side, so obviously cross-chain voting will fully work in this DEX that's going to expand everywhere. And then the number of pools right now is limited that the relays can vote for, so that can have like some trade-offs with yields potentially in some conditions. And anyways, bunch of upgrades just to ensure if you toggle that autopilot button and you go on hiatus for 6 months, you come back and all you got was the best you could possibly have gotten.
I think that makes sense. Maybe to jump to another topic, I'd love to get into the details here with you on Slipstream V3. Like maybe can you give us some background explainer on it, walk us through it, and then we can dive in?
Yeah, so there's a ton of stuff coming in Slipstream V3. So like Slipstream V2 has been like an amazing success, right? Anywhere it's deployed, like Base or OP Mainnet, it's competing against basically like 10 years or 8 years of Uniswap's development, Uni 2, Uni 3, Uni 4. It's taking a 3-to-1 margin, right? So it's very, very successful. And like one of the portions of that, just to highlight it, is right, we direct rewards just into the active tick of liquidity. So only productive liquidity is utilized. And those rewards come in the form of Aero emissions. So that reward rate is constant, right? It's not going up and down based on volatility. And when you combine those two things with dynamic fees, right, which are adjusting the fee rate like surge pricing based on volatility in the market, it means you have kept liquidity sticky and you can undercut fee-based sort of exchanges competing for flow in moments of low volatility. And then you can increase the amount of liquidity you have available relative to them, and then charge higher rates when the volatility hits. So it's almost more like order books now, where you're actually correctly internalizing the value relative to the flow. And Slipstream V3 will have a new upgraded dynamic fee mechanism. It'll have things like payment for order flow, Robinhood Citadel style. So if we know that, every bit of flow coming out of Coinbase.com or the Base app or, in the future, Robinhood, things like that is non-toxic, then we can offer a preferred fee rate for that flow because you don't need to charge as much. And in doing so, we can ensure that we win, the vast majority of that flow completely organically, right? Not by cutting a deal, not by being privileged, but just knowing that those are better rates that we can offer. And this is also very important, by the way, with the expansion of FX, because if you think about like payments processors, service providers, I mean, we know right now, like on EURC, USDC, we're giving a rate like 500x better than Wells Fargo gives on a euro to dollar conversion. We're giving like 20x better than even like Wise can often give on these types of transactions. And you need payments processors who are also going to be non-toxic to be able to get that kind of preferred rate on their flows as well. And so we think this is really important. And the other big thing in Slipstream V3 is this verification stack. So we can plug into Coinbase verifications, we can plug into like world verifications, any of these sort of KYC like things, which we think will continue to sort of be a slow burn, but it is a really important thing to have the ability to build in as more institutions come on chain and the need to validate, who is trading, or at least that they are, not baddies in these pools. And that's another big important part of it.
Go ahead.
It's all very exciting. I have one with regard to the Euro C USDC thing. I've always wondered how has the I think oftentimes we hear a lot about like order books bringing in new forms of equity or FX trading, but it's not as like discussed within AMMs or in the AMM space. Have you guys seen like a significant change in activity in terms of like real world assets, or has it not hit the level that you would have expected yet? And maybe like a follow on to that is V3 and like the verification, you guys' attempt at making sure that more and more activity can come on.
Yeah, I mean, the verification, I mean, anything that is composable and permissionless is going to be able to track liquidity and activity in a far more capital efficient way, we'll say right now, right? Until there are major institutions that are going to come in and you could give them all the KYC liquidity that they want, but if they're not going to generate enough activity to sustain it, it's not going to be very useful. And I think that's like what you've seen on the like verified pools that Coinbase launched on UniV4 is almost no activity yet, right? Because we haven't solved that cold start problem quite yet. But like just as an example, on the EURC USDC pool, I can't remember when it was, sometime last year, Circle came to us and they were like, this is the only FX pool that we have found anywhere on chain where there is real organic activity that we can't attribute, right? Somebody is using these pools for something versus this is just like a pool that's got bootstrap sort of static liquidity and occasionally catches some ARBs. And so I think it is happening. I think that is only going to accelerate. I think that is, again, why I think ARC is very, very interesting, because what happens when you pair the best on-chain EURC pool plus a bunch of global issuers of other local currency stables that are very, very high quality, and you have an on-chain sort of FX market that can also tap into lending markets to leverage up and sort of do these things. Like, I think it's only going to accelerate. But yeah, we've been like, I think blown away because like there's no extra incentives or anything on top of the EURC pool. That thing has been self-sustaining for quite some time.
I imagine Circle was a little bit concerned if they don't know exactly who is doing it and why they're doing it, though, right? Like they must have at least had some thoughts. We need to understand who is doing this.
I mean, I don't think that hits them because, if they are just the ones issuing the USDC and EURC, tokens, and obviously you can't go in and redeem those if you're just anybody. They're very, very happy for widespread permissionless distribution and access of those things.
That makes sense. Is the MEV internalization going live with Slipstream V3, or is that a separate additional product on top of it?
That is part of the V3 launch, and that's a big one because if you think about the total addressable market, the amount of revenue that MEV creates for sequencers, I mean, it's more than like Aerodrome and Velodrome combined made in revenue the past year as, again, the leading DEXs in the space. So for us to have the opportunity to internalize that revenue, right, by doing this sort of MEV auction at the AMM level versus doing it at the sequencer level and intercepting it, that is like a massive new revenue stream that we're able to internalize to the token, which means, of course, that token that we're emitting into the active ticker liquidity represents now even more than trading fees plus launch payments plus everything else, right? We are just increasing the rate at which we can reward over a fee-based DEX for a liquidity provider, which I think compounds our moat. And that's all the more significant, in this period where we now have competing economic models in the sense of Uniswap actually pulling back a bit on how much they're able to reward liquidity providers at a moment where we're actually trying to increase over swap fees, the amount that we can reward liquidity providers.
I think that makes sense. I have one more thing, Danny, and then you can go ahead. I assume the MEV, I think the MEV internalization can only be for Ethereum. And then it's kind of a janky segue, but Uniswap is very, very dominant on Ethereum. Now, do you think that is mostly because there are no good competitors out there? Or do you think it's going to be a struggle for you guys? Now, you've done very, very well on Base and on Velodrome and on like wherever you guys have launched. So I don't mean this in like a way like, oh, are you going to be able to compete? But more like, what is the strategy to compete? Because in my mind, that's like their biggest thing, right? They don't have a lot of other areas that they're very competitive in right now.
Yeah, I mean, I think our answer is very much intrinsic to that, right? We have tested now MetaDEX 02 against Uniswap in, I can't remember every chain, but let's just say it's 6-7 chains, right? And in almost all conditions, the MetaDEX model takes not just like a winning share, but like a dominant share versus Uniswap. And so I think we're very confident that bringing the same model that has shown an ability to compete and win against Uniswap to mainnet Ethereum will allow us to capture a significant amount of share, especially with the upgrades that we're bringing in MetaDEX 03. But in some ways, it's interesting that we've been able to take that sort of 3-to-1 dominance against Uniswap in a period where they were still heavily able to subsidize their costs with the token, right? So they were rewarding LPs with 100% of fees because the token didn't get anything. So if we've been that competitive against them passing through all the value that they're generating, if you cut fees to LPs by 25%, which is the average, I think, of what they are doing right now, that makes our competitive advantage, I think, all the more significant. Because if you go back to the SushiSwap vampire attack, which was, I think, the last time Uniswap really got tested on mainnet Ethereum, what did SushiSwap do? They just provided some degree of additional value on top of LP rewards sufficient to attract mercenary LPs over to them. And SushiSwap took 50% of Uniswap's share in about a week. And so we think, as they're dropping yields and we're increasing them and we're taking a model that is already very, very competitive and extending it into their home market, we're very bullish, I think, on our potential. And by the way, it's a very interesting thing because last time I looked at the numbers, if we just captured 30% of mainnet, we're the largest DEX anywhere, period. And I think it's an open question, what has kind of held up, Uniswap's, extreme premium in the market. And I guess I would believe that it's probably because they have still remained kind of number one. And if we only need 30% of mainnet, and then, folks have to start asking the question, is Aero, now going to be this number one exchange? And what does it mean for Uniswap if they are not? I think you could get some pretty crazy flywheel effects, both positive and negative. But I also just love let's make mainnet fun again. Let's make DeFi fun again. I mean, when's the last time we had a good, exciting battle, like the old days?
Yeah, that's true.
Yeah, I like your viewpoint there, Alexander. I think maybe interestingly to talk about mainnet a little bit, it's not necessarily the case that they haven't been losing share. We know Fluid has had quite a run this year on mainnet, something like 15% of market share now, I think, from the last time I checked the data. So I think it does maybe showcase the point that there's potential to sort of break into that market. It's not like they have an iron grip on all the activity there. So probably, to your point, there's opportunity to compete. That said, I guess I'm curious, like maybe your general thoughts on kind of the EVM DEX landscape going forward, given, the competition we're seeing. Even on base, I think, like PancakeSwap has seen a rise there. Is this, is it product led? Is it, rewards led? Is it, who do you think are going to be like the winners going forward, and how and why in the EVM DEX space?
Yeah, I think, when I think about who will be the winners, I think you have to start with what does winning mean, right? And I think when you're evaluating a DEX, right, you have to take into consideration the core metrics of a DEX, right? So TVL matters, but not in isolation. Volume matters, but not in isolation. Fees matter, but not in isolation. And revenue matters, right? But not in isolation. So you take those four together and you get a very different view of the DEX landscape. And so this will be like one of the times, it's rare, but it happens. Like I'll defend Uniswap. Fluid, I don't think has actually cut into Uniswap's fee share on Mainnet. They have cut into their volume share by charging very, very low fees on stable swaps that don't produce a lot of value. And so I would assume that Uniswap's share of fees on Mainnet has remained pretty healthy. And then there's been some noise about Curve, but you have to isolate Curve fees from yield basis fees. And same thing. I think Uniswap's share of fees remains pretty constant. You can get distorted if you're looking at volume. And that's the same thing for like Pancake on Base. Pancake has grown a lot of volume on incentivizing pairs that don't generate fees. So we don't worry much about them because there's not really any value to necessarily be captured there. So I think like the competition is definitely going to be fierce. Like it's going to be a lot of fun. But I think if you look across those metrics, it'll be very, very clear who is actually winning, right? How much net new value is being created, how much volume flow that's winning, and how much capital flows into those systems. And I think there should be a pretty clear, undisputed number one winner across all those four key metrics in pretty short order. I think what we've seen so far is it's distorted by the fact that not everybody's competing everywhere. I think Fluid, Uniswap have been competing everywhere for a long time. I think the MetaDAO model has not, but it's really clear anywhere it competes across those four, it wins hands down against all of them combined. And that is, I think, what makes us very, very bullish on the model, especially knowing it's getting a massive upgrade even from where it is now, with significantly more value coming into the system, less going out, and then all these other technology and UX upgrades.
Yeah, I guess as a follow-up to that, what do you think about, well, on Ethereum, this should be fine, but how, like, on L2s, if we're doing order books on prop AMM systems, what do you think about, I guess, a traditional AMM seems a bit weird to say about Aerodrome, but you know what I mean?
Yeah. I mean, I think order book like experiences, the prop AMM, they're all going to have their kind of like niches and value and things that they serve. But I think permissionless AMMs, the composability, the distribution, the reliability, the transparency of them, you can't beat those network effects. And there's actually another thing I saw, Hayden go to bat for AMMs recently, and I think he was absolutely right. If you look at the prop AMMs on Solana, it's servicing, of course, Sol USDC volume greatly, but it's not servicing much else, and it's not very transparent. And we all remember what happened on like October 10th when that liquidity was needed, it was gone. So there are trade-offs, like there are niches, but I think continuing to build upon the economics of permissionless DEXs, right? Continuing to internalize, verticalize more value, use it to reward liquidity providers, ensure that liquidity is constant, it is available, it is transparent, it is permissionless. The networks of effects of this will continue to grow, which is, by the way, right, why folks like OKX, like Coinbase, are directly integrating DEXs into their core products and now distributing this infrastructure. So I always think the contrast for like a on-chain order book or even some of the prop AMMs or even some of the like KYC pool stuff is, well, just go on a centralized exchange. They're great. They are great at doing a lot of those things if that's what you're looking for. So what we need to do is build something better on-chain. I think we're doing it. That's why centralized exchanges are integrating and distributing these products. And that as the industry continues to grow, that will be where most of the economic activity is created.
I think
I'm curious. I think you make a great point that we're seeing centralized exchanges route orders to DEXs. I think that's a trend we'll continue to see grow. I'm curious if you have an opinion there on whether we see Binance make that move in broad fashion, like in 2026, or if they kind of try to hold on to like their kind of crown or mantle longer.
Yeah. I I mean, I think we've already seen them do a bit of this, right? In how they've integrated in with Pancake Swap, right? And Binance Alpha and things like that. I think it's clear that there's like a very close relationship between Pancake and Binance. But yeah, I mean, I think they'll do it as long as there's a net benefit to them. And I do think as permissionless distribution of assets continues, it's harder and harder for any centralized entity to keep up with it, because the life cycle and number of tokens is just going to keep, life cycles are going to keep getting shorter and shorter, and the number is going to keep going up and up. And so why would you leave any money on the table and not distributing that to your customers, charging some sort of fee and things like that? So yeah, I mean, Binance was probably, earlier to some degree of integrating between these two than many. Whether or not they go for sort of the full stack integration, we'll see. But I think it's inevitable for kind of any forward-facing consumer crypto company to distribute DeFi products generally.
Yeah, I agree with both of you guys on that. I think it makes sense. With the Coinbase app integration, have the flows been different to it? I don't know if you guys do this. So I guess I should have first asked if you look into the data of what you get through your front end, what you get through API or contract integrations, and what you get through the base app. Is that different? And you could do dynamic fees for that as well. Is that something you guys are considering?
Yeah. Yeah. So, I mean, that's the whole idea behind having this sort of dynamic fee and payment for order flow, is that, most DEXs, I believe it's pretty standard in the industry. It's like 10 to 20% via the front end. Everything else is aggregator, programmatic, sort of stuff hitting the contracts or routers directly. It's a pretty big split. And then if you go into where those flows are coming from, something like fee rebates or dynamic fees, associated with that, ensures that of that 80%, the programmatic stuff, you can win more and more, right? And so, yeah, we would want to win every single trade originating from a Coinbase, every single trade originating from a Robinhood, every single trade originating from the base app, just by giving them the best rate. And our system allows us to do that, by the way, without fragmenting liquidity. And this is a big difference, right, between our sort of modular approach to building the AMM versus, the hook style in UniV4. Because if you wanted to build a UniV4 AMM that does something similar, you could do that with hooks. But now you're talking about bootstrapping that pool itself. If that's a wrapped ETH USDC pool, if it's a creator coin pool, it's competing against the other pools with that. So how do you get that pool to maintain that? We can do it basically without fragmenting liquidity. We can modular adapt to the mechanisms of dynamic fees. We can modular plug in new flow providers like Coinbase or Robinhood directly in there. And we will just win on execution and execution alone. And it's not a bad deal for LPs because it's non-toxic flow.
I think that makes sense. I imagine a lot of crypto is going to be moving towards this, both on the AMM side, or I guess the DEX side, as well as on other protocol. Danny, unless you have something as a follow-up, do you have anything as a follow-up?
Go ahead. No.
Alex, one thing that I think is on, I guess, liquid investors' minds about Aero, and we won't approach it from that angle, but it's the emissions. And you guys also recognize that the emissions can be a little bit difficult. You have something that is changing with MetaDAO 03, so I guess you can run over that a little bit. But in general, was emissions a necessary evil initially that you're going to taper off of completely eventually? Or is it more so that we'll always need them, but eventually we're going to be making revenues that will just, emissions won't matter anymore? Is that the viewpoint?
Yeah. So I think it's super interesting because in my mind, emissions haven't been much of a factor for some time. So let's just take a look at Q4, right? In Q4 on Aerodrome, more revenue came back to the token than was emitted. So that would be, a net gain for everybody. And that's even assuming you're not doing a calculus of how much was removed from circulation via locks. That was just a pure net gain, more in than out within MetaDEX 02. And the current inflation rate, right, is about 10%. This is not a massive inflation rate on an annualized basis. So you've got a net more in than out. You've got a relatively reasonable inflation rate. And the question is always like, for me, so what are we benchmarking against? Because the ratio of emissions to revenue on most protocols is infinite, right? Until a few weeks ago on Uniswap, it was infinite for years. And now that we actually have data on Uniswap and we think about the 20 million uni tokens that Labs is going to need to spend in the next year, sell, it's about $120 million. And the current back testing on the fee switch says it will only bring in about 20 million. So like our historical emissions to rev ratio is about like 1.5. So we're beating Uniswap today on our historical. We were net positive, which Uniswap doesn't look like it'll be likely able to do in the next year. So I would say even within the current form of the protocol, we've got the best DEX economics, period. And the big upgrade, though, as you mentioned, is that we are internalizing all of these new revenue streams. So things like MEV, things like aggregation, things like compounding, all of these different streams, value streams that DEXs leak. And we estimate, the cumulative market size of all these revenue streams to be in the billions. Launch payments, stuff that traditionally goes to centralized exchanges. And so that means more value in, while we can dynamically adjust emissions out to ensure we're never basically pushing out any more than is needed. And so in our back testing, right, just the Rev and Air engines combined represents like a 2.8x net increase over what in Q4 was already a positive economic output from the protocol. If we bring that net close to 3x, much better. But then you also have the addition of the Momentum Fund, which is going to be buying back tokens market aware. It's going to be burning those tokens. So it's actually going to be removing supply entirely. And that pushes the estimate on those backtesting closer to 4 or 5x net improvement for token folks. And that's before you even think about the expansion into the additional 4/5 of EVM fees that we don't compete for right now. So I would always say, if you're worried about any of these, I would say first, what are you comping against? Like, who do you think's got a better sort of argument here? But then B, today is pretty good, right? And then, with these improvements, it's only going to get better.
I think that makes sense. But I guess the only thing in my mind here is if you're doing 10% inflation a year, is that, how do you because so from what I understand, I've studied the Aerodrome trilemma as much as I can. So you have the LPs, the token holders, and you want to make sure that both of these benefit, because historically either token holders don't get any benefits or LPs in either case get kind of a bad deal. You're rewarding LPs with the Aero token. How do you decide on that? Is that a set that you per pool? Are you guys going to start adjusting that such that do you get what I'm trying to say? In my it's always been kind of confusing to me how you guys exactly LPs need exactly 8%. We're going to be giving them exactly 8%. Is that the math that you're doing, or is there?
That is what the Air engine will be able to do, right? So Air stands for adaptive emissions rate. So on a pool by pool basis, it will be able to calculate a premium over fees and ensure that we are only emitting more than what you would get on a fee-based DEX. So we will ensure that we can always give you more than Uniswap at 100% fees, definitely more than Uniswap at 75% fees, but never much more than needed. Never a scenario where we're emitting like 2x more, 3x more, 4x more. So that's what allows you to bring down the economic out while still ensuring that you are rewarding LPs at the highest rate, which means that liquidity is there. So then when the flows come, obviously the dynamic fees are ensuring we're like capturing as much value from it as possible. So yeah, that's a big part of it. But even I'll just do a quick plug because Dan, our CFO, did a presentation at the New York event, and he walked through sort of the back testing. Because if you look at even the past year, if you're just thinking about a liquid token holder, the protocol has been net much more value coming in than you've a cost in emissions, even with emissions having been over the course of that year much higher than 10%. So with these upgrades, like it is very, very possible that the protocol is not just net profitable, but net like deflationary from a liquid token standpoint.
Where do you see, like from the new initiatives, the new products, expanding new ecosystems, like when we think about like net positive protocol economics, where do you see, the most potential for kind of like net profit growth for the protocol in these areas?
Yeah, I mean, I think the two biggest ones would be launch payments, right? So that's things like our ignition launches, right? Because we know that it feels like an eternity ago, I guess, the big debate about centralized exchanges, how much they were charging for listings, right? But we know we market size that it's probably about $1 billion. Centralized exchanges have made taking like 10% plus of token supplies and basically extracting that value from the project. So like launch payments, if you can disrupt that business model, you can internalize it into an AMM, is a huge one. And that is why I think you see, a bunch of folks like Uniswap with their new CCA and other folks continuing to experiment around this. But the other is MEV. That is also hundreds and hundreds of millions each year that AMMs leak that value to sequencers. They don't have to. You can internalize those. So I think those two things combined in terms of net new revenue streams. But every dollar we capture, every percent we capture on a network we do not currently serve is incremental dollars to us. And again, I think that's why it's so interesting to think about the fact that like Curve has been everywhere for a while. Fluid's been everywhere for a while. Uniswap's been everywhere for a while. Who actually has like a credible growth story, right? An additional market to go win, plus a right to win, and proving that every new market we enter, we will gain significant share of. And so I think those two streams in terms of net new revenue in will probably be the biggest, but probably the biggest is just going and winning more of the DEX total addressable market.
Yeah, that makes sense. And also, as you get stuff like launch, for example, you don't have to emit tokens to launch. So that's also adding additional revenue.
Every new revenue stream does not depend on emissions.
Yeah.
It adds more utility and value to the emissions, right? But it is all incremental. So it is just increasing the net by which we can reward. And that is why, I always think like the sushi swap example is one we've kept in our heads forever, because if you give LPs more, they will move on a dime. And so you can never, and Uniswap commissioned their own research on this from Gauntlet that talked about the effects of cutting LP rewards. So we've done everything to design our system in ways that increase LP rewards and never decrease them. Because we think if you decrease them, what Gauntlet said, you get a reverse flywheel effect. And the lifeblood of any DEX is, do you have the liquidity that traders can access? Because they won't care if they're on Coinbase and it hits us, if they're on a wallet and it hits us, an aggregator and it hits us, or somewhere else. They're just looking for the best rate. So attract enough liquidity to always give it to them, you win. And you win very, very quickly.
Yeah. Seems like because the AMM, I noticed that last time I said trilemma, I didn't say all three of them, but like that AMM trilemma is. I agree that you guys have probably the best solution, and that the others just don't have a solution. It's kind of like, okay, well, one of the sides has to struggle.
Yeah, it's robbing Peter to pay Paul. It's a really hard thing. It's a fixed set of stakeholders, and I don't think there's any solution beyond kind of maximally passing on value between them, which allows them to each act in their rational self-interest, such that everybody does better. And actually, at the event, the other plug I'll put in is watch Jonas from Wintermute Ventures talk on this, because they are obviously, one of the world's top traders. And he describes the way in which, we just act in our rational self-interest. And that got us so interested in why is it always like hitting Aerodrome, which turned them into a token operator, a locker, right? They went out, bought, and now participate on that side. And again, only in their self-interest there. And that's a sort of like flywheel reinforcement that you can only get if you are solving for all three simultaneously.
Yeah, I think that makes sense. Danny, do you have anything else, or shall we wrap up?
No, I thought that was great. Great conversation, Alexander. Glad to have you on again.
Alex, thanks for coming on. This was great. I'm happy we got to kind of grill you on the emission side, because I've always wondered how you guys are thinking about it, but clearly there is like an expansion plan into new products that will just add net new revenue without emissions, which I think makes sense.
Yeah, no, I love the grilling. My dad told me every now and then he'll listen to a podcast I'm on, and he's like, I don't always know what you guys are talking about. He's like, but sometimes it seems like people don't ask you hard questions. And I'm like, that's probably actually fair. So yeah, bring me on, grill me anytime. I love it.
Yeah, thank you for coming on. And I guess thank you to our listeners for tuning in to the first live stream of the year. Danny, do you want to also say goodbye? Do we have to say anything else for the wrap up? No, we're good.
I don't think we have any shout outs to give other than to the listeners. Thank you guys for showing up. Appreciate Alex from Dromos Labs, the new Aero.
I forgot to ask something. Alex, people will get upset at me if I don't ask this. What is the timeline for MetaDAO 03? What are we looking at?
Good question. Q2 development is actively underway. Any builders in the space know usually the biggest dependency is audits. So that's why I don't want to get more specific, but we are very, very focused on as early in Q2 as the things in our control can go.
Okay, that makes sense. Perfect. Alex, thanks again for coming on. Danny, thanks for co-hosting. Listeners, thank you for listening. Goodbye.
Thanks for tuning in, y'all.